Now that we have discussed operating leverage and described operating leverage, calculated the degree of operating leverage, let's turn our attention to the second form of leverage, which is financial leverage. By financial leverage, we mean the amount of debt that's used in the capital structure of the firm. So we're really talking about how the operation is being financed. We're going to use debt or we're going to use equity. It turns out that this is an important consideration, and it's going to impact earnings for our firm fairly significantly. If the firm is performing well in an operating sense, financial leverage magnifies the good performance, and we have very high earnings. Having said that, if the firm begins to perform poorly in an operating sense, then financial leverage is a sword that cuts two ways, and it's really going to create problems for our firm. So financial leverage just impacts the performance between two firms that have otherwise identical operating activities. To put financial leverage sort of in the context of operating leverage, it helps to think of both operating leverage and financial leverage in the context of the balance sheet. On the left-hand side of the balance sheet, we have assets. On the right-hand side, we have liabilities and equity. Operating leverage is really all about assets, which assets we choose to purchase, what fixed assets we're going to apply to the economic activity that we're concerned with. The right-hand side of the balance sheet, we're talking about financial leverage, how much debt we have relative to the amount of equity that we have. So it's helpful to think of leverage as being essentially impacting the balance sheet in two ways: the left-hand side through operating leverage, the right-hand side through financial leverage. Let's talk about the impact on earnings of financial leverage, and we'll do this by considering two firms, theoretic firms, that have identical assets, but they have in place different financing plans. The reason we do this is because we're able to focus exclusively on the financial leverage element. Given that the firms have exactly the same assets, their operating leverage doesn't matter at this point. So for our firm that has identical assets, we'll consider the firm as having total assets of $200,000. That means we have to have liabilities and equity of $200,000 because our balance sheet has to balance. We have two sources of potential capital. One, we can issue debt that has an 8% interest rate, or we can issue common stock. So depending upon how aggressively we choose to lever our firm, we're going to have different amounts of debt. In Plan A here, our levered firm, we've chosen to borrow $150,000 of capital, and we're going to only sell $50,000 of capital, which is 8,000 shares at $6.25 a share. We add those two up, and we get $200,000, which is exactly the amount of our assets. So we mentioned it has to be. So our levered firm, leveraged or levered firm, has $150,000 in debt at 8%, and $200,000 and $50,000 in equity by selling shares for $6.25 a share. Our conservative plan, Plan B, we'll do that in black here. Our conservative plan, we're only going to issue $50,000 in debt instead of $150,000. We're issuing $50,000. That means we have to issue more stock, again, issued at $6.25 a share. The sum of those two is our $200,000, exactly matches our total assets. So we have two competing plans. The one that's in red here is our levered plan. The one that's in black is a conservative plan. The only real difference is that the conservative plan is borrowing $100,000 less and issuing $100,000 more in equity, and the number of shares that are being issued are issued so that the pricing of the shares is $6.25 per share in each case. All right, let's turn to what the impact is going to be, and to do that, we'll look at this chart. This chart is also replicated in the textbook. It might be easier to follow in some cases in the textbook because there's a lot of data here. But what this chart shows us is, in the two right-hand side columns, we have Plan A here in red, Plan B here in blue, and we have 5 different alternative operating performances for each of these. So each of these 5 scenarios, we have differing earnings before interest and taxes, in other words, differing operating income. So while we have firms with identical assets, we don't know in the future exactly how well those assets will perform. In other words, we don't know what the economy will be like. We don't know what the earnings potential of those assets are. We have a range of possible outcomes. At the low end, in scenario 1, the earnings before interest and taxes are 0. At the high end, in scenario 5, earnings before interest and taxes are $60,000, and in between we have earnings of $12,000, earnings before interest and taxes, EBIT of $16,000, EBIT of $36,000. Okay? Let's look at we'll clean up a little bit here. If things play out badly and we find ourselves with 0 operating income, in Plan A, our levered firm, even though we don't have any operating income, we still have to pay $12,000 in interest expense. Okay, we owe $12,000 of interest on that. That's 8% of $150,000, and we're going to be able to deduct that for tax purposes. Presumably, we have some carrybacks, or in any event, our taxes can be negative. We'll get some money back from the government. Our earnings after taxes, then, if our tax rate is at 50%, our earnings after taxes are negative $6,000. We have 8,000 shares outstanding, and we have a loss of 75 cents per share. If we had gone with a less aggressive financing strategy, we would be looking at only $4,000 in interest expense, which is deducted. We only get $2,000 in tax refunds. So our earnings after taxes are now $2,000, which are split among 24,000 shares, and the loss is 8 cents a share. So we're actually earning, we have bigger losses from our more levered firm. On an operating basis, we didn't lose any money, but because we owe that fixed cost, that fixed debt cost, interest expense, we see losses. If we had $12,000 in operating income, we'd go through exactly the same process. We would find earnings per share under that scenario to be exactly 0 for our levered firm, and for our unlevered firm, we're actually showing a profit at that level. If we have earnings before interest and taxes of $16,000, operating income of $16,000, we'll discover we're in a break-even situation between our two firms. In each case, they'll earn, and I don't mean break-even in the sense that we've seen previously, I just mean that these two firms would have the same earnings per share. Okay? Now, why is that? Well, remember, we have $20,000 in assets, or $200,000 in assets, rather. and we're at $16,000, we're earning on our assets 8%. That's $16,000 of EBIT. All right, so at $16,000, we have earned exactly 8% return on assets. That 8% return on assets is exactly equal to the cost of debt. Remember, we're borrowing at 8%. So when we're earning exactly the same return on our assets as our debt cost, then whether we are more levered or less levered has no impact on our earnings per share. We're earning enough to cover the debt cost totally, but nothing extra. We're earning enough on our assets to cover that debt cost, but we don't earn any extra. So we're not being penalized because we don't earn enough to cover the debt cost. We're not being rewarded because we're not earning more than the cost of our debt. So that 8%, because we're borrowing at that, when return on assets is exactly 8%, we get that unique situation where we would have been indifferent between how much leverage we took on. We'd have the same earnings per share under either scenario. We could look at $36,000 in earnings in EBIT. Let's drop on down to scenario 5, which has $60,000 in operating income. When we had $60,000 in operating income, we still are only having to pay $12,000 in interest. So our $12,000 in interest allows us to, our earnings before taxes is $48,000. We pay $24,000 in taxes. So our earnings after tax is $24,000 divided by 8,000 shares. We get earnings per share of $3. In our more conservative scenario, we only deduct $4,000 in interest. Because we're only deducting $4,000 in interest, our earnings before taxes are $54,000, but we're paying $28,000 in tax instead of $24,000, and we then have $28,000 in earnings after tax. Now, the earnings after tax is higher for a more conservative plan, but we also have a lot more shares outstanding. So on a per share basis, we're only earning $1.17 per share. So we see here in our, I guess I should have done all this in blue over here, okay? But what we see is Plan A. That first plan that we have here, Plan A, has when we have high operating earnings, Plan A pays off. In scenario 5 down here at the bottom, being aggressively financed and having higher leverage paid off for us in higher earnings per share. But when we were in the scenario where we didn't have very good operating results, the leverage really hurt us. We're posting bigger losses as well. That is the essence of financial leverage. In good times, financial leverage helps our earnings per share. In bad times, it hurts. Let's look at a graphical depiction of what we just had, and this is not just the 5 points that we saw, but for any level of earnings before interest and taxes. For Plan A, as EBIT, which is down along the bottom here, EBIT's along the bottom, as this operating performance gets better, earnings per share rises very rapidly. Okay? There's the 0 point. When we've got poor operating results, we end up with this area down here where we're actually posting losses under Plan A. For Plan B, when earnings per share is our earnings per share also goes up, but it just doesn't go up at as steep a rate. And so for really good outcomes out here, when we're out in this part of the world, we're going to wish that we were more highly levered. But when we have very poor operating performance back in this area back in here, we're going to be glad that we didn't have higher leverage.